Good evening, everyone. I would like to welcome you on behalf of the President and the Executive Committee of the chapter to the webinar conducted by CA Sri Lanka, chapter of Western Region KSA. For today's session, we have CA members joining us from Sri Lanka, UAE, Bahrain, Kuwait, Qatar, Riyadh, and Dammam KSA. We also have members of other accounting bodies and colleagues from other professional bodies participating. I thank you all on behalf of the chapter for accepting our invitation and joining with us today. CA Sri Lanka members, please type in your name and membership number in the chat box. Participants, please feel free to post your questions relevant to today's topic in Q&A box. Our panelist today is Raditha Alakon. Raditha is a partner in KPMG Sri Lanka. He's a member of CA Sri Lanka and holds a degree in finance from University of Sri Jayawardhanapura. Raditha is well versed in accounting, income tax, auditing, and financial accounting. Raditha, over to you.
Thank you, Usman, for that lovely introduction. And if we rewind our minds, to the history of lease accounting, we had a accounting standard called IS 17 before IFRS 16, which was initially came into the effect way back in 1990s. And it was a very old standard without any modifications. But in year 2007 and 8, there was a discussion on the previous accounting standard of IS 17. And this whole thing started, especially you might remember this special remark from Sir David, who was the former chairman of ISB, and he made a remark saying that one of my great ambitions before I die is to fly in an aircraft that is on an airline's balance sheet. And I found this very true because I happened to audit one of the largest seaplanes fleet in one of the countries. And what I found was, surprisingly, none of those aircrafts were recorded in the balance sheet of that seaplane operator. And way back in 2016, again, a lot of discussion started, and the US regulator started with a survey which basically resulted in an outcome. They said this is a very significant standard for the economy because the estimated size of all these lease commitments are going up to USD 3.3 trillion. But out of that, almost 85% of them are not appearing in the balance sheet. So after several discussions and all these discussions, both ISB and FASB started implementing a new lease standard which came into effect in 2019. Now we all have basically our hands on with IFRS 16. That is why I titled this as this is the new normal of lease accounting. But the significant fact is the application issues or the implementation challenges that we saw in 2019 are still coming up as application issues or the practical issues. So what I will do during next 1 hour and 15 minutes, I will try to cover the important aspect of the standard, giving more significance to the practical applications and the outcomes and some of the insights that we have seen during the post-implementation period. And not only that, I will try to cover the major update after the implementation of the standard, which came into the effect in 2021, the lease concession, which is specifically basically designed to respond to the challenges came out of the COVID pandemic. And we will keep balance 15 minutes to exchange our ideas and for to get into a Q&A session. So that is the agenda for the day. And if you see any accounting standard, it will have 3 major topics. The first one is to decide whether a particular transaction is within the scope of that particular standard. The second one is the recognition and measurement of the standard. The third one is the presentation and disclosure. If you see any other standard, except for few standard like which are mainly concentrating on the disclosure part like IFRS 7 and the related party disclosures, the complex area out of those three topics would be recognition and measurement. But for me, when it comes to lease accounting, the most complex area is not recognition and measurement, but it would be to decide whether a particular agreement contains a lease or not. Why it is complex? I was in Maldives for some time, and all these islands where the hotels have been located are leases from the government, and you will have a lease, head lease for almost 50 to 60 years, and somebody will secure the head lease and they will sublease it to a hotel operator, and the hotel operator will take it back, and then he will construct a hotel in that lease land, his own asset. And then what they will do is sometimes they will ask all these high wealth people like Ronaldo, the football players, they will ask them to come and invest in a particular villa. Let's assume Ronaldo comes to Maldives and he will buy a particular villa in that resort. And what happens? He's not going to stay for the entire year, but he will lease it back to the operator again and will tell, okay, I need it for 2 months. The rest of the period, you can give it back to your customers and give me a share of revenue plus X amount. So what you can see is there is a one arrangement, but there will be multiple lease implications. Whether those transactions are leases, whether those transactions are not leases, whether part of these arrangements will come under the lease definition is one of the key and tricky questions. So that is why I said, in terms of lease accounting, more significant and the complex area would be defining whether an agreement is within the scope of the lease or whether it contains a lease. So what do you mean by a lease? Lease is normally defined as, if the contract conveys the control of the right to use of an asset for a specific period for a consideration, those type of contracts we will regard as lease contracts. So if you have a contract which goes towards for an indefinite time period without having a lease term, those type of contracts will not form part of leases, because in economic sense, the indefinite time period will have the same substance of a own asset. So those will be excluded from the definition. And apart from that, if you want to identify a contract, whether it contains a lease or not, there are three main questions that you might have to ask. What are those? The first one, whether do you have an identified asset? If you answer yes, then you might have to go towards another question, which is who or the lessee obtained substantially all the economic benefits or not. Okay, I answered there is a identified asset. The next one, lessee obtained substantially all the benefit of the lease. Then I will go down to the third question, which is whether lessee direct the use of the asset. So if I ask all these questions as yes, then my conclusion would be the contract contains a lease. So if any of these questions, if I ask as no, then my conclusion would be contract does not contain a lease. So why these three questions are complex and very difficult to answer? Let me take the first one, whether there is an identified asset. Now, as a result of COVID pandemic, what we have seen in Sri Lanka, there is a large shift of those who used public transport have now been shifted towards using these private staff transport arrangements. And let us assume if I want to travel from Moratuwa to Golface, I will go and approach a transport provider and I will come to an agreement with him. Let's see if the agreement terms are as follows. He will accommodate, two morning and the evening transport facility for me. And I want a specific seat in the staff vehicle. Let us assume I want the second row, second seat for me to be allocated during this transport arrangement. So that means if the second seat of the second row is not available, I am not entitled to sit any other seats of the vehicle. So what is your guess? Do I have a lease or do I have identified asset in that particular arrangement? If I slightly modify the arrangements or the contract terms, if I put it like this, let us assume, yes, he will provide me this transport facility for both morning and evening, but now there is no specified asset. There is nothing called second row, second seat. Whenever I get into the vehicle, he has the ability to give me any of the seats which are available in the vehicle. If that is the case, do I have a specified asset or identified asset? Or does the agreement or the arrangement meet the definition of a lease? When it comes to the conclusion, it's most probably that the first one will meet the definition of a lease. The second one will not meet the definition of the lease. Simply because the first one, there is a specified asset given in the agreement. And if that particular asset is not there, then my consumption will, or the economic benefits will be get affected. But in the second arrangement, there is no specific seat for me. The driver or the supplier has the ability to alternate all these assets and give me the service. The first one will be most likely a lease. Second one will be most likely a service arrangement rather than a lease. So this is why it is going to be a little complex when it comes to deciding whether an agreement contains a lease or not. So how do you decide? The first one is to look at whether there is a substantive substitution right for the supplier. And the two questions that you have to answer, they are whether the supplier or the lessor has the practical ability of substituting an asset throughout the lease period. In our example, what happened was, in the second example that we discussed, the supplier had the ability to substitute the seat whenever he required, and whether the lessor benefits economically from that substitution. For an example, if there's a chubby guy who get into the bus, in the second case, the driver can ask me to move into another seat and give the second row, second seat to that particular guy, so that he will be economically benefit. So if these two conditions are satisfied, then most probably we will conclude that even though agreement is very similar to a lease, there is no identified asset in that particular arrangement. So there is no lease in such contracts. If you put it to a commercial agreement, for an example, let us assume you are a soft drink manufacturer and you want to distribute all of your soft drinks to these retail outlets. So what you will do is you will go and approach a distributor or transporter who has a large fleet of vehicles. See if you draw up an agreement to say that, so these are the vehicles with the vehicle numbers which will be used to transport my goods. Most probably we will have an identified asset. So the arrangement will meet the definition of a lease. But we structure the agreement in a way that it says these are all the vehicles that I have. Whenever you require, I will send one vehicle, and it is not specifying which vehicle. So in that case, most probably you will not have an identified asset because the supplier has the substitution right and he has a practical ability to do so because he has a large fleet and he can economically benefit from that substitution. So now you can see very similar arrangement. Depending on how you describe and specify it, the outcome may be significantly different. So if these two conditions are satisfied, there is no identified asset, so there is no lease. But if you answer no, then there could be a identified asset. So most probably, if the other conditions are satisfied, the arrangement will meet the definition of a lease. So what is the next one? Next one is the capacity options. Now, when it comes to leases, most of the time it's related to the capacity, whether it's a building, storage, or a aircraft, whatever, it will be most probably related to capacity. If the asset can be physically distinct, then most probably you will end up having an identified asset. But if the asset cannot be physically distinct, then most probably you will not have an identified asset unless you are substantially benefiting or consuming almost total, or the substantial share of the total capacity or output of that particular asset. Let me give you an example. Let us assume you are in GCC region. Let us assume I am a gas distributor, and I want to store my gas. Now there is a party who has constructed a large gas tank. I go and visit that, but I found the capacity is too much for me. I don't need that amount of capacity. So I will draw up an agreement to say that I need only 60% of capacity of this particular tank. The balance, the supplier can rent it out to somebody else. But there is no compartments in that particular tank, so that all the gas, my gas, and other people gas will be stored in that particular tank. So if that is the case, my capacity cannot be physically distinct from the other people's capacity. So most probably you might end up in a conclusion to say that the agreement does not contain a lease, and there is no identified asset there. But if we modify the fact pattern of the example, let us assume you are again a distributor, and there is a party who is constructing a gas pipe, which is underneath a commercial or the agricultural land. So I go and visit the pipe. Again I find that the pipe is too much for my capacity. So I drew up an agreement to say that I will only distribute 75% through the pipe. The balance 25 can be given to somebody else. But what if it's a remote location and there is no other party who is going to distribute? If I am the only one who is going to substantially consume all the capacity of that particular asset, if that is going to be the case, then I will find there is an identified asset. So the agreement might meet the definition of a lease. So what about this land surface and the underneath pipe? Can we bring an argument to say that it cannot be separated from the land because it's one land? No, the pipe can be separated from the surface, and the farmers can do cultivation in the surface, and the amount that I invested for the pipe can be considered as a lease agreement. So this is the case for most of the facilities that are being used in those agricultural lands, like sometimes in the wind turbines, and sometimes we find these the telephone towers. All these are very small portions of the land, but that specified area will most probably meet the definition of a lease. So you might have to bifurcate the land area, the rest of the land area, from this specified land area, and that particular land area might have to be accounted as a separate a lease arrangement rather than looking at the land at as a one whole unit of account. So if I cannot physically distinct my capacity, but if even I am if I am substantially consuming all the output, still the arrangement will meet the definition of an identified asset. So if otherwise, let us assume I am a retailer. I have so many retail shops around the country, and I want to store my goods, and I have somebody who is providing storage facility, and he has a large building with 10 equal size rooms. If I go and get the first 6 rooms, then it will be 60% of my capacity. He can give it to 40%. He can give it to somebody else. If in this particular agreement, if something happens to these 6 rooms, if I do not have an ability to store my goods in other 4 rooms, then most probably my capacity can be distinct from the other people's capacity, and I will have an arrangement which contain the lease. But if you redraft the agreement in a way that there is no substitution right, then most probably I will be ending up with a conclusion to say that there is no identified asset. So similar contracts, but different conclusions based on the fact pattern. So that is why the application of lease definition itself become very complex. So what is the second one? So we discuss how to define an identified asset and what are the things that we have to look for, the substitution right, as well as distinction of the physical asset. The second key question that we have to answer when it comes to identifying the asset or identifying a lease contract would be whether lessee obtains substantially all of the economic benefit of the lease. So what do you mean by that? So when it comes to economic benefit, you have to look at for two things: the primary output plus the secondary or the ancillary output. If you are a party who is constructing, producing power supply using thermal, then what will happen? You will have primary output as well as byproducts. So when it comes to the evaluation of the economic benefits, you have to look at both primary outputs as well as the secondary outputs. And assume the primary output you will be giving to the electricity board, but still the secondary or the byproducts will be sold to the general public. If that is the case, if this byproduct is a substantial portion or else it's a significant portion, then the agreement might not meet the definition of a lease, even though the plant is purely constructed for the use of CEB or the electricity board or the national authority who consume the electricity. So let us go through some practical examples to see how to decide this, some of the application issues. Let's see, there is a 55-year contract for a customized solar panel output. Supplier receives renewable energy credits. So who is consumed the primary output? The primary output would be consumed by the solar or the supplier, but the other benefits will be, or the credits will be consumed by the supplier. So in that case, the primary goes to another party, secondary goes to another party, then substantially all the economic benefits will not be achieved or consumed by the lessee. So there is an office contract and the tenant sublease 25% of its space. So what is the primary output? Primary output is I will occupy. The secondary benefit is, I have the ability to sublease it. But whether it's sublease or I use it, both the outputs are consumed by the lessee. So if that is the case, most probably the substantially all the economic benefits will be consumed by the lessee. So you will have a lease in this case. Let us assume retail stores. There is a retail store contract. the arrangement is the rental will be paid fixed amount plus 20% of revenue. Now, what about these revenue sharing agreements or else profit sharing agreements? You can think that when you share your revenue with somebody else, that you are going to share part of your output with somebody else, so that substantially all the economic benefit is not consumed by the lessee. If you have profit sharing arrangement, again, you are going to transfer some of the profit to the other party as well. So I'm not going to consume all the economic benefit of the asset. The answer is no. But standard look at is whether you have the ability to generate all the cash flows. The part of the revenue or the profit will be just a mechanism how you price the arrangement. But when you lease it, you have the ability to generate all the cash flows that can be derived from that particular asset. And part of that will be an arrangement how to pay for that particular asset. So it does not preclude saying that agreement does not meet the definition of a lease, or you do not consume all the economic benefit. But what if the arrangement says, okay, you can only take 5% of profit and the rest always has to be transferred? In that case, somebody can bring an argument to say that your return is limited, so you are not going to consume all the benefits, so that the agreement might not contain a lease. In this case, most probably, it is the primary output, and substantially all the benefits will be consumed by the lessor. So there is a two get charter, share access and use with another party. So if that is the case, primary output is not going to be shared only by you. It is dividing between two parties. The agreement will not contain a lease. So the third one, who direct the use of the asset? If the lessee is directing the use of the asset, then most probably the agreement will contain a lease. So we discuss whether there is an identified asset and who is going to substantially obtain all the economic benefit of the asset. And the third one would be who is directing the use of the asset. So let us see some fact patterns. The customer enters into a 2-year contract with a supplier to transport cargo from one destination to another destination. Ship is exactly specified in the contract, and the cargo will occupy substantially all the capacity of the ship. Do I have an identified asset? Answer is yes. Why? The asset is specified in the agreement itself, and the supplier has no substitution right. So what about the economic benefit? Out of the total capacity, the cargo will occupy a substantial portion, so the economic benefit will be consumed by the lessee. So what about the directing the right to use of the asset? It is in question, because fact pattern does not give us significant insight into decide who is directing it. So how do we decide who is controlling the right use of asset? So who takes how and what purpose decisions throughout the lease period will determine who is going to control the right use of the asset. So as a result, whether there is a lease arrangement or whether we do not have a lease arrangement. If this how and what purpose decisions are being taken by the customer, then most probably the arrangement will contain a lease subject to other conditions are satisfied. Let's assume the how to use the asset and for what purpose the asset should be used are being decided by the supplier, then the arrangement will not contain a lease. But the complexity would be in the most of the agreements, this how and what purposes are predetermined in the agreement itself. If those activities have been predetermined in the agreement itself, then we have to go and look at two things. Who is operating the assets? Who is giving the operating instruction for the asset? If that is done by the customer, then we will conclude saying that agreement contain a lease. Or else, if that particular lease is specifically designed for the requirement of the lessee, then the lessor will not have an alternative use of the asset. So it is through the agreement itself, it's designed specifically for the need of the customers. The operating instructions are part of, is inbuilt into the agreement itself from the customer's side. So if that is the case, again, we can conclude saying that the agreement contain a lease. All the other cases, we may conclude saying that agreement does not contain lease. So remember, when it comes to the directing of the asset, controlling of the asset, then decide who and what purpose decisions, who is being taking those decisions. What do you mean by how and what purpose decisions? How to produce it, the production methodology, what purpose to produce it, and when to produce it, to whom to produce it. All these decisions are being taken by the customer. If those decisions are being taken by the customer, it will contain a lease. If it is being taken by the supplier, the agreement will not contain a lease. But this do not misguided by the protective rights of the supplier in any of the arrangement. Since the supplier is giving the asset on a lease, to safeguard the asset, there may be certain protective rights which are inbuilt in the agreement itself. For an example, the asset should be maintained in a usable condition. There will be a maximum usage of the asset, and there will be a particular location where the asset should be used, and the maintenance conditions, though those will be part of the agreement itself, but those are just protective rights that will not, preclude saying that the customer does not have the ability to take how and what purpose decisions. But if the protective rights are so significant, so that the customer does not have ability to take enough decisions in terms of the asset, then you might come to a conclusion, but most of the cases, protective rights will not hamper your decision. Yes, for an example, let's do a small practical application. The case A, contract specified. We are going back to the old example that we discussed. We have identified ship, and the cargo basically counts significant part of all the capacity. Now, the contract specifies the cargo to be transported and the date of pickup and delivery. Supplier operates and maintains the ship, is responsible for the passage of cargo on board. So which, how, and what decisions are being predetermined, and the asset will be operating by the supplier. The case B, contract specifies the cargo to be transported and the date of pickup and delivery. Customer hire the captain, but supplier provides the crew. Case 3 or case C, customer decide whether and what cargo will be transported and when the ship sail between two ports. Supplier operates and maintains the ship, and is responsible for the safe passage of cargo on board. So what would be our conclusion in terms of directing the use of the asset, or whether there is a lease or not? In the case A, I would say there is no lease, because the what purpose and how it should be run is predetermined, and supplier is operating the asset. If that is the case, we will consider saying that the supplier is the one who is directing the asset, not the lessee. But in terms of B, it's highly judgmental. Now, other all the the what and which purpose are being predetermined. But when it comes to operation, now it is divided between supplier and the lessee. So lessee appoints the captain, but the crew is from the operator. So who is directing the ship? I would say I will go with lessee, because captain will take the ultimate decision when it comes to the operating decisions. Other people's might have to adhere to it. So it might be a conclusion, will come to a conclusion that the arrangement contains a lease, but it's a highly judgmental. The decision involves a high judgment. The case 3 is straightforward. Customer decide where to be transport, how to be transport, when to be transport. So those decisions are be taken by the lessee, even though the crew is from the supplier. So key decisions are be taken by the lessee itself. So there will be a lease in the agreement itself. So what we discuss how to identify whether the contract contains a lease. We have to answer 3 questions. The first one, whether there is an identified asset. How do we evaluate it? We have to go and see 2 things: whether the supplier has the practical ability to substitute the asset. The second one is whether the capacity can be distinct, physically distinct from the other capacity. The second question is, who is consuming the major part of the economic benefit? If it is going to be the lessee, then you will have a lease. If it is going to be the supplier, you will not have the lease. You will consider both primary output and the secondary output when you take that decision. The third one is, who is directing the use of the asset. Then you go and look for how and what decisions. If it is being taken by the lessee, you will have a lease. If it is taken by the supplier, you will not have a lease. If those decisions are predetermined, we will go and see who is operating the asset. So now we have discussed one of the complex areas of the lease standard: how to decide whether an agreement contains a lease. So when you decide whether the agreement contains a lease, do we need to apply the lease accounting that we discussed, the on-balance sheet, one single model with ROU asset in the balance sheet for all these leases that we decided previously? So if that is the case, it's going to be very difficult sometimes. But standard has given certain exemptions when it comes to the lease application. The first one is short-term leases. If the lease term is less than 12 months, then you have the practical ability to take those leases out and account for them as short-term leases. So what you will do is you will charge the rental over the period of 12 months to the PMA. Now the application issue here is, people very often misunderstand with the time period given in the agreement with the lease term. Let us assume if the agreement is agreement says that the lease period is for 5 years, but if it says once and every at the end of each calendar year, you can exit from the arrangement without any penalties or any insignificant cost, then most probably we will conclude that even the agreement says 5 years, the lease term is 1 year. So evaluation of lease term is going to be one of the key aspects. Even though agreement says 5 years, 10 years, actual lease term with regard to termination conditions as well as the renewal can be longer than the agreed period or shorter than the agreed period. So here what we will look at is the lease term based on the analogy of IFRS 16, not just what is documented in the agreement. So if the lease term is less than 12 months, you will apply short-term lease classification for it. And the other one is a low value views, low value items, the small items that you will consume. The analogy that had in mind, which is given in the basis of conclusion of the standard by ISB, is the items which are less than 5,000 USD, which is not given in the standard. So there is no such threshold. You can take it as an analogy, but the intention is you can apply these the practical application of this is you can apply this asset by asset basis, and threshold will be decided when the asset is new. That means even though you take 100,000 of mobile phones for your company, in aggregate it will be material, but how you apply the standard is you look at the value of each and every mobile phone rather than in aggregate. If that mobile phone, when it is new, is less than 5,000 or fairly a number which is not so material, then even though it is in aggregate material, you still can apply the low value use exemption, so you are not going to record an asset in the balance sheet. For the lessor side, there is no exemptions. So what are the other exclusions? These are general exclusions, and I will touch upon on one of the important aspects for you guys. That may be the first one, lease to explore or use mineral, oil, gas, and other natural resources. So if there is an agreement to extract or use this type of, the natural resources, then it may be oil or gas, then such agreement will not form part of leases. There is a separate standard, you all know, that will be specifically dealt with that. But the question would be, what if you are leasing a land with these oil farms and gas deposits? So does it come under the definition of the leases? I would say it is not specifically addressed in the standard, but I would say even though you lease the land, it might qualify for the scope exclusion from IS 16, so IFRS 16, and going to the other standard. But something that you might have to be mindful when you see that the whole arrangement or the whole lease of land might contain access roads, adjoining land, staff quarters, and so many other facilities. If that is the case, you might have to bifurcate those facilities from the area where these gas deposits and the oil wells are located. Those areas might come under the definition of IFRS 16, the rest will go out. The other ones are very, things that known to us, so I'm not going to spend much time because we do not have much complexities over there. So what is a lease application model that we have? We have a single model. The model is you take all the present value of future lease payments and you record it as an asset. You designate that asset as an right use of an asset, and the same will be recorded as a liability in your balance sheet. And when it comes to the P&L, you will start depreciating the right use of an asset, and you will charge interest on the liability. So the interest will go to P&L, also the depreciation will go to P&L. So altogether, depreciation and the interest will form part of total expense to the P&L. So that is going to be the model for you when it comes to the application of the leases. So let us take one example. There is a 5-year lease of an aircraft, and 1 million per annum USD will be paid as rentals. No renewal or purchase options. Discount rate is 7%, and the aircraft useful life is 20 years. So how do we record the RU asset? So now the lease term is for 5 years because there is no renewal options as such to extend it beyond 5 years. So 1 year lease payment is 1 million into 5 years and will be discounting it by 7% discount rate. You will debit 4.1 million as your right to use of an asset, and you will credit the same amount as your liabilities. Then after one year period, you will start depreciating the assets, the 4.1 million divided over the period of 5 years, and recognize into the P&L. And you will charge interest on the outstanding balance on the lease liability for 4.1 million into 7%. You will recognize as interest to the P&L, and you will credit it to the liability. And when you pay the amount lease rental of 1 million, what you will do is you will reduce it from the liability. So 1 million of lease payment first year will consist of 270,000 of lease interest plus the capital repayment of 713. So this is how the balance sheet and the P&L recognition will happen. Altogether, 820 of depreciation plus 287 will be the total amount that will be recognized in P&L as lease expense related expenses in the balance sheet. So what is the impact? Impact would be in the initial, you will have asset and the liability which is equal, and then you will start depreciating the asset so that the asset value will start coming down, and the liability value also will start coming down. So the initially asset value will come down faster than the liability, and ultimately both will become zero. So when it comes to the profit or loss recognition, as I discussed, depreciation and interest will be the total expense that you are recognizing in the P&L. So the initial years, your interest portion will be significant because the interest will be front loaded, because the amount of reduction in the capital repayment will be less in the initial years. So you will have a bulk payment of interest in the initial years, but you will have a straight P&L charge for depreciation. So when it compares with the previous lease rental charge, operating lease rental charge, initial years, your expense will be high, but towards the end of the contract, your expense will be lesser than what you used to charge into the P&L as operating lease rentals under IAS 17 previous lease standard. So the impact to your ratios, since now you are not charging lease rental, instead of that you will charge interest and depreciation. Because of that, your EBITDA value will increase. So if you want to report now, you will report the EBITDA value rather than the net profit, operating profit. If you want to make a lucrative announcement, you will slightly modify your response to it. And the balance sheet, the total assets will go up because now the assets will be recorded, and the gearing will go up because the liabilities is going to go up. Initial years, the EPS will come down. As I said, the initial years, the expense is high due to front loading of the interest, and the net assets also initial years will go down, and the interest cover also will go down. So this is the impact for your P&L balance sheet with the entries of the one single on balance sheet model of IFRS 16. So the lease accounting initial measurement is one of the key aspects of lease accounting and a judgmental area. So when it comes to the lease liability, how do you measure the lease liability initially? Lease liability is nothing but the present value of all lease rentals plus the present value of expected payment at the end of the lease. If there is a residual guarantee or any payment that you are expected to be paid to the customers at the end of the period. So the present value of both together will be your lease liability. So the key inputs that we might have to deliberate upon would be what is the lease term, and what is the lease payment, and what is going to be my discount rate. The lease term, in my view, would be the most judgmental area when it comes to the application of the lease. It starts with non-cancelable lease period. You might draw up an agreement which for 5 years or 10 years, but what you have to first start is looking at what is going to be the non-cancelable lease period. Let us assume if the agreement contains a clause that either party can cancel or terminate the lease agreement with 90 days of notice period. If that is the case, most probably the lease term will be limited only for 90 days, not for 5 years. So always you start with non-cancelable lease period. Let us assume you have an agreement. You have obtained a lease asset, which is let's say a machinery, and you can use it whenever you want. You can return it back to the customer. supplier. So that is the arrangement of the lease. If that is going to be the case, without any significant penalties, you can redeliver your asset to the supplier. So the non-cancelable lease period will be only 1 day. So if that is the case, all these leases will qualify for the less than 12-month category of short-term leases, even though agreement might have been drawn up for 5 years, 10 years, or 20 to 25 years. So that is about how you evaluate non-cancelable lease period. So what about the agreements with, without any specified terms? It says, you can give notice and exit, or else you can, renew it all the way up to X amount of years. If that is the case, before you decide on the lease, you have to factor all the economic incentives of that particular agreement. Sometimes I have seen even in the related party agreement, there is no specified lease period, which says, either party can give notice and exit. But what you have to look at is the other economic benefit that will be derived from that particular asset. Let's assume there is a land I have built, done leasehold improvements, which might go up to over the period of 5 years. If that is the case, my exit will be highly unlikely because my exit cost will be very high. If that is the case, you are not going to terminate or consider as a short-term lease. You will consider this estimate period because you have an economic incentive to go up to 5 years. So that is how you will start evaluate the lease term. Then you will go for the optional renewal and the termination clauses of the agreement. So if there are options to renew, then you have to go and see whether you are reasonably certain that you will renew the agreement or not. So if there is any economic incentive for you to renew it, then you will most probably renew if the option is given for the lessee. Let's assume the agreement for 3 years. I'm a bank. Agreement is only for 3 years, but I have constructed a huge branch there. So if that were to be the case, most probably I might go extend my lease for another period because my exit cost will be higher than my renewal. I might renew because my exit cost will be high, so there is an economic incentive for me to do that. The optional termination, again, also you will go and see whether it is reasonably certain for you to exit. Just because there is a contract clause which says that you can give notice and exit, you are not going to just assess it. You will assess it whether it is reasonably certain that you will exit from it. Even though exit clause is there, if you have done significant improvements, it is highly unlikely that you will exit. So you will take the longer period rather than the period of non-cancelable lease period. So this is how you will apply this lease term into the calculation of ROU, asset and ROU, or the lease liability. So let's look at some practical examples, practical application. There is a 5-year lease of a machine. Annually, you pay 10,000. There is an option to terminate after 12 months for the significant penalty. So if there is a significant penalty, most likely that I will not exercise my termination option. So option to renew for 2 further 5-year period will be there. The lease uses the machine to manufacture car parts, which must supply for 10 years. Significant installation cost is required. Why the lease term is important? You can see when the lease term increases, your liability also increases. So whether you have incentive to terminate or renew leases, the first one, you annually paying 10,000, and it's at the current market rate. If it is current market rate, I might relocate it, or I might take another machine if required. So there is no significant economic incentive for me. The second one is option to terminate with significant penalty. So this significant penalty will discourage me in terminating the lease. So again, there is no renewal or termination will not be exercised. Option to renew for further 5 years at a market rate. Since it's for the market rate, again, I might not have incentive to do so. Lease uses the machine to manufacture car parts, for it must supply for 10 years. Now, lease is for 5 years, but my supply for 10 years. So that might encourage me to renew it further. And the significant installation cost also will be an incentive for me to extend the lease term. So these are the other market conditions that we have to look at when it comes to the extension of the lease term. So the contractual market rates, the level of the secondary period, whether it is market rates, whether there are any contingent payments, purchase options, the relocating costs, those are some items that you might consider, as well as in terms of asset conditions, the nature of the item, if it is specialized, the location, substitute alternatives, those are the other economic conditions that I might consider when I decide the total lease term. So lease payment, when I look at the lease payment, the first thing you will look at is the fixed payments, then the termination penalty. If it is reasonably certain, I will include that also in my lease payments. If there are any purchase options and if I'm reasonably certain that the option will be exercised, again, that also will be included in my lease payment. If there is a residual value of the residual guaranteed value, then the expected amount also will be included in the lease payment. And when it comes to the variable lease payment, if it is based on index or a rate, I will include it. Otherwise, I will not include it. What do you mean by that? If it is linked to an inflation index or a property market index, in that case, I might include such escalation of the lease rental into the lease payment. But if the lease payment is varying because of my turnover or usage of the vehicle, I am not going to include that into the lease payment. So for these famous revenue sharing agreements, you will have fixed rental plus 20% of revenue. You will only include for the RU asset calculation the fixed amount, not the variable component. The variable component will be charged to P&L whenever it incurs based on the revenue. So the initial calculation, what you consider only the fixed repayment. You will consider variable lease payment only if those are linked to an inflation index or a property index most of the times. So lease payment termination penalties, based on the assessment of the lease term, you will include the purchase options also in question. If it is reasonably certain, I will include it. Variable payment based on sale or usage, I'm not going to include it. I will charge to P&L whenever it incurs. Variable payment on index and rate, I will include. Residual value guarantees will include based on the expected payment of the residual value of the guarantee. So let us discuss another small example. 15-year lease of a wind farm, usage payment of expected lease of 1 million per annum, usage payment for extreme low value users of 700,000 per annum, maintenance cost is 10,000, restoration cost of 100,000 at the end of the lease. So what are the things that you will consider for the ROU calculation as lease payments? So include or the lease liability. Do you include the usage payments? No, we discussed usage payments are not included as lease payments in the calculation of lease liability. The maintenance expenses, You have to bifurcate the lease expenses and the other expenses separately. The maintenance expenses will be excluded from the lease payment calculation. Restoration expenses also will not be included, and that is part of IS 737 contingent liabilities. When it comes to restoration costs, you will accrue it, but under a different standard, which will not part of IS 16. The last one, when it comes to the lease liability, the discount rate. There are two discount rates which has been specified in the standard. The first one is the rate implicit in the lease, or which is readily available in the agreement itself. That is the case for most of the finance leases. The agreement itself will tell you what is the yield or the rate of interest, and if that is not explicitly given in the standard, then you will take the incremental borrowing cost. What do you mean by incremental borrowing cost? Depending on your current leverage, if you go for another finance for a term which is approximate for the lease liability, the tenor, what would be the interest rate that a corresponding bank might charge from me? So if the lease liability is like for 70 years, it is not necessarily that you have to go up to 70 years, because what you can do is you can approximate with how you are going to finance a long-term asset with another loan. Let's say I might go for a 20 years lease, then 20 years borrowing, then you might take 20-year borrowing rate. Depending on your current balance sheet, what is going to be that borrowing cost that you are going to incur? You take that borrowing cost and start discounting your lease payments in order to arrive at my lease liability. So you can see when discount rate fluctuates, the lease liability also fluctuates. So sometimes I have seen when it comes to practical application, people reluctant to take this high interest rate. They want interest rate to be lower, but in terms of actual application, I haven't seen very significant impact of it, because if you discount it with a lower value, what will happen? You will have a higher ROU asset, so the depreciation will be high. If you take a higher interest rate, your liability will come down, so the ROU depreciation will be less. However, the interest charge for the respective periods will be high. So whatever the rate that you select, in terms of actual practical application, I haven't seen major impact of this interest rate, even though people used to fight a lot for this interest rate. How do you calculate the rate implicit? You take the present value of the lease payment and any residual guarantee values, and you take the fair value of the asset and the initial direct cost, and taking these cash inflows and outflows, you will try to calculate the IRR. So that will be considered as rate implicit in the lease. So that we discuss about the lease liability. The three key things that you have to look at would be what is the lease term? Look at the optionalities, renewal clauses, termination clauses, and the non-cancelable lease period. The second one would be what is the lease payment? What are the components that will include the lease payment? Remember, only the fixed component will be considered. All these revenue sharing mechanism will not form part of lease liability, will be charged to P&L whenever incurred. And the discount rate, select an appropriate discount rate. So ROU asset, lease, start with lease liability, and if you have initial direct cost, you will add that. So this is a benefit that you can derive all these stamp duties and the other charges, legal costs, all these direct costs which you used to charge to P&L now can be recognized as part of ROU asset going forward. And if there are any prepaid lease payments, that also should be added to the lease liability, and the cost of dismantle or restoration will be added to the lease asset, but will not be part of lease liability. It will be a separate liability under IS 17. If there are any lease incentives, that has to be deducted from the ROU asset. So the subsequent measurement of the leases, amortized lease liability will be amortized cost using effective interest rate. You will have the opening liability, you will charge interest based on the interest rate, and you will deduct the repayment. You will come at the final lease liability, which is very similar to the measurement of amortized cost. RU asset, you'll start with the opening RU, and you will start depreciating it over the period of the lease term or the useful life of the asset, whichever is low. Then the impairment testing has to be done. If the RU asset is subject to is impaired, then the impairment test has to be done, and you have to charge the impairment loss to the P&L. But in my the experience, RU asset will not be tested for impairment as a standalone asset. Most probably it will be part of a cash generating unit. So if the cash generating unit itself is impaired, most probably you will test the RU asset as well. Otherwise, most probably it may not be tested as a standalone asset. So look at these aircraft, which are under significant pressure and rent concessions that you have given. If the space is now not occupied, the impairment issues will come up. Then the alternative method is, you can revalue the RU asset. You can apply IAS 16 model or IAS 14 IP model for the fair value of the asset, depending on the nature of the RU asset. So what you are going to fair value is not the underlying asset. Let us see, if you have leased out a land, you are not going to fair value the land. What you are going to fair value is the right to use the land. So there are two definitions of fair value. So do not go and fair value the land and record as RU asset, revalued RU asset. What you have to look at is only the extent of right to use of the asset, not the underlying physical asset of the which is subject to a lease. So the remeasurement of the lease, whenever there is expected amount and the residual guarantee value is changed, or the index or the rate is changed, the lease term is changed, what you will do is you will remeasure the lease liability and reflect it. And when you remeasure it, the first three items will be measured using the previous discount rate, but balance three items will be discounted using the new or the revised discount rate as at the remeasurement date rather than the original discount rate. Then we go into remeasurement of the RU asset. The change in carrying amount will be remeasured amount will be added to the RU asset or deducted from the RU asset. Then the variable component will be basically will be charged to P&L, and if these in substance payments are there, then the component relating to the future years will be added to the RU asset. The component related to this particular year will be charged to P&L. When it comes to the lease modifications, you will go and see the modification, whether it increased the scope of the asset. Let us assume you had 3 floors. What do you mean by scope of the asset? It has to increase either RU underlying asset, usage of the underlying asset, or else the lease consideration. So if you increase another floor of their agreement, and if that floor is giving a separate standalone price, then that will be considered as a separate lease asset. All the other cases, if it is not part of a standalone price increase, you will remeasure your RU asset and you will do the adjustment considering it is a lease modification. So if there is any decrease in scope, you will remeasure RU asset. The changing or the delta value of RU asset will be charged to P&L going forward. So we will come to last bit of the discussion, the rent concessions. of the leases, the rent concessions are primarily for the response towards the COVID-19 pandemic, which came last year. The initial exemption was only to 30th June 2021. Now it has been extended up to 30th June 2022. So still, the rent concession given during this period for the pandemic will be subject to the lease concession, and you will have practical expedient in terms of accounting rather than applying these more complex lease modification approach. So what is it? First, you have to go and look at whether this change is in accordance with the terms of the lease. If there is something like COVID happens, whether the reduction of lease is part of the lease agreement or not. If it is yes, then you account it as a variable lease payment under the IFRS 16 accounting guidance, that you will charge it to P&L and finish it off. And if the rent concession and if that rent concession is purely in response to the COVID situation, then standard has given you a practical expedient that you can apply, or else you can treat it as a variable lease payment. All the other cases, you will conclude saying that the application of modification guidance is appropriate. So what is the practical expedient given in the update or the new pronouncement which was issued last year? The first thing you will go and look at whether the rent concession is direct consequence of COVID-19 pandemic. If it is yes, you apply the practical expedient. And if the revised consideration is original amount, or if it is less than amount for the previously, the rental amount, then again you will apply this practical expedient. So if the rental amount is going up, no practical expedient. This is for the concessions given for the leases. So it has to come down from where it was previously. So does the rent concession reduce only lease payment originally due to 30th or no before 30th June 2022? For that period of lease concessions will only form part of this practical expedient. Only other terms and conditions has to be substantially unchanged for you to apply this particular practical expedient. If altogether all the conditions are going to change, it will be a new lease rather than a practical expedient application. For an example, so you have three clusters of lease concession. The first one is unconditional rent forgiveness. The second one is rental forgiveness, which is conditional. The condition is if the government continues to lock down, then it will be waived off. The third one is a rental deferral. You are not going to reduce the rental or waive off. It will be deferred, and the future lease payments will be increased, and you will get a holiday period for the payment of the rental during the pandemic time. So how you will account for it? The first one, the rent concession, which is unconditional. So what you will do is basically you will calculate the present value of those rentals. In our example, it will be 2 rentals. You will calculate the present value of the 2 rentals, which has been given as a rent concession, and you will deduct it from the lease liability. The corresponding gain will be immediately recognized into the P&L as your gain. So the second one is the rent concession for the conditional rent forgiveness. In this case, you will get the concession only if the lockdown happens. So if that is the case, if the lockdown happens, what will happen? That will reduce the amount of lease liability for that particular month, and the lease reduction will be recognized as part of your gains to the P&L. So you consider as a lease payment and gain to the P&L if the condition is satisfied. The third one, the rent concession for the deferral. There are two approaches that has been discussed. The first one is very similar to the, the first one is what you will do is, you will consider those two deferral as lease payments, and you will deduct it from the liability, and then you will separately recognize it as a deferred payable. When you have to pay it additionally, you will debit that lease deferred payable, and you will again increase the lease liability. So initially you will deduct it from the liability and create another liability. When it becomes due based on the new contract terms, you will reduce it from the liability, and again the liability will be increased in the subsequent period. So the next one is lessor accounting. Lessor accounting is not going to change under the new accounting standard. It's going to remain same. For the lessors, we will have the two classifications of finance lease and the operating lease going forward for the lessors as well. The only differences will be in terms of how you define the lease, sale or leaseback guidance, sublease arrangements, so on and so forth. So no symmetry between, how lessee account for the leases and how lessor account for the leases. In terms of lessor accounting for the leases as well, very similar to the modification guidance given in the given to the lessees as well. If the ROE asset is increased with a new price, then you will consider it as a separate lease. But if it is not standalone price increase, it's a revision to the consideration, then what you will do is you will remeasure it. If it is an operating lease, you will recognize it as a new lease. But if it is on a finance lease, there is no asset given in the balance sheet. It will be the receivable from the lessee which is recorded. So you will apply IFRS 9 application for those finance lease. So if it is operating lease or a lease with which increase the scope with a standalone price, you will consider as a new lease. If it is a finance lease, you will remeasure the finance lease receivable, and the gain or loss will be recognized to P&L. The other lease application issue that I would like to discuss is the sublease. It is one of the major components when it comes to the application issues, and we have seen a drastic difference between how it was in the IAS 17 and under IFRS 16. So what you do, for an example, if you are doing if there is a piece of land, if I secure the head lease, and if I give it a sublease to a third party, now I have to look at this head lease and the sublease separately. So you will account the head lease based on IFRS 16 guidance for the lessee, because in terms of the head lease, you are the lessee. So you will create an IROU asset as well as a lease liability to finish the accounting for your head lease. Now, when you sublease it, now you are the lessor. Now you will go and apply lessor accounting for the sublease arrangement. So how do you do it? You will go and see whether the sublease is going to be an operating lease or a finance lease. So most of the time, if you sublease it for the remaining lease term, that means the major part of the remaining lease term is going to be consumed by the subleasing. So if that is the case, applying the lessor guidance, if major part of the economic life of the asset is going to be consumed by the lessee, then you got to de-recognize the asset. In the sublease analogy, you consider the ROU asset which has been recorded as the asset. So you de-recognize the ROU asset and you will create a receivable as considering this is as a finance lease. So how do you measure this finance lease receivable? It's similar to how you account for lessor accounting for finance leases. If there is any difference between the present value of the future lease payments for the finance leases and the carrying value of ROU asset at the date of the sublease, the delta value will be recognized in the P&L as immediate gain or a loss. Whenever you receive money from the sublessee, then you will reduce the net investment in lease receivable from the balance sheet, and you will continue to charge interest income on the receivable, very similar to finance lease arrangement. So there is no change how you account for it. The simple analogy that you have to look at is you look at the head lease as lessee and account for your ROU asset and ROU liability. In this case, the original lease term is 50 years. After 20 years, you are going to sublease it to a third party. So in that case, the next 30 years is going to be consumed by the sublease. So he is going to consume the major part of the economic life of the lease. So it becomes a finance lease from the point of view of the sublease. So I become the lessee and he is going to consume the lease. So I will de-recognize the asset. In this case, the asset becomes the ROU asset that I have already recognized from my head lease. I will remove it and I will bring a receivable which is called net investment in lease receivable. So I think I have taken additional 10 minutes. This is due to the initial hiccup we had during the opening session. The lease is a very large topic. Normally takes not 3 to 3.5 hours to discuss, but I try to condense it as much as possible. Sir Winston Churchill once said, a good presentation should be similar to ladies' skirt. It should be short enough to attract the audience. So I think I finished within the time frame so that we are not going to fed up, but it should be long enough to cover the subject. I hope I covered most aspects of the standard with some bit of practical application, so that your time is not spent. So the rest is all about the answering to Q&A. Thank you very much for the Kata chapter for inviting me. Usman, over to you.
Thanks, Pradita. That was very detailed and very good. I mean, I'm sure that the people who joined today got very good understanding. I mean, it was very, very clear, and you touched upon very important points also. Right? It's very comprehensive. So we have some questions. I think we can take 5 or 10 minutes, answer this before we wind up. There is a question. I have recognized some lease asset in my books in 2019 with the estimated lifetime of 3 years. Now those assets are, now that asset is fully depreciated and the net book value is 0. But still I'm using that asset and expect to use for next few years as well. So my question is, can we stop working on IFRS 16 since it's fully depreciated, or do I need to reassess the lifetime and discount the cash flow again and bring the value to the book?
Very good question. I think the first thing you have to look at is whether your useful lifetime assessment is correct or not. So in that case, if you are going to continue to use the asset, is most probably the estimation of your useful lifetime is not correct. And since you have already fully depreciated it and you still continue to use it, most probably it is an error of the estimation of your useful lifetime. So if the lease term is still remaining and you have already depreciated, you might have to bring the asset back through a revaluation or other method to restate it. with the correct useful lifetime assessment. So it will be IS 10 adjustment for that.
Okay, I hope that answered the question. And there's another question. If a company has obtained an outlet for 6 months rental free, and if the rental payments start from month 7 and outlets start operating from month 7, when we should capitalize the right to use? So there is a rent-free period involved here.
Yes, it's another lovely question. I think the first thing I would look at, there is two concepts. The first one is the lease inception date and the lease commencement date. So most of the time, if you are doing a retail operation, if you entered into an agreement, let's say to lease it, but there is a period where you do certain type of modifications, so on and so forth, but the actual use will happen after 6 months. Let's say if there is no rental payment during that period, and if it start after the lease period, what we have to look at is what is the point that you agreed the terms with the lessor. If it is agreed and the lease was formalized 6 years prior to start operations, and that is the lease inception date. So the counting for leases happen at the lease inception date. So the RE asset should be recognized the lease inception date. I hope in this particular circumstances, you principally agreed upon on all the conditions 6 months prior to the operationalization of the lease, so that it has to start 6 months prior to start operating the lease.
We are running out of time, and maybe we can take just 2 more brief questions and then wind up. There's another question. If the lease rentals charged during the lease period of a building lease after the initial recognition. So the question is, if the lease rentals changes during the lease period of a building after the initial recognition, how should the adjustment be made to the already accounted lease assets?
So can you repeat the question, Usman?
Yeah, so the question is, if the lease rental changes during the lease period of a building after the initial recognition, so how would you do the adjustment?
So it is okay.
Yeah.
Okay. So what we have to look at is whether it is due to index or any other variable lease payment. So if it is the change in lease payment is due to index or so on and so forth, then you will apply the remeasurement guidance. If the lease rental changes due to the variable lease rental, like revenue or something like that, you will charge it to PNB. And if it is due to some other reason apart from those two, let's say you renegotiate the lease rental due to certain changes, then again you will see why you increase the lease rental. If it is because you increase the usage of the lease asset, then the increase, if it is a standalone increase due to the increase of the scope of asset, that particular part will be a new lease. Otherwise, if it is just a renegotiation of the lease payment due to some other reason, it will be remeasurement of the lease. What you will do is you will take the new cash flows, you will do the expected cash flows, the calculation, present value calculation, and you will remeasure the lease liability. Difference will be added to RU asset. That is how you will be accounting for it. But remember, if it is for reason for index payment or any other variable lease payment, it has to be dealt separately. So there will be 3 cases: index, variable lease payments, or any other increase due to the usage of the asset. Then it becomes a new lease. Otherwise, it will be a modification of the lease. So you'll adjust to the RU asset and the liability.
Okay, I hope that answered the question, and I think we can take one last question before we wind up. This question is about software. Company uses software as a service, a kind of online trading platform developed by a third-party vendor, and pay a monthly rental to the vendor for usage. shall we be able to capitalize such software rental payments as right to use under intangible asset?
So it is under intangible asset, and most probably it will be scoped out from IFRS 16, and IS 38 will have specific guidance in terms of how to account for this, including cloud computing, which was revised very recently, but might have to get more details if I want to address this issue in terms of 38. It will be scoped out from 16, and it will be part of 38, the software arrangement. Usman.
Thanks, Radhika. I think we have answered all the questions posted by our participants today. Thank you, Radhika, for your time, especially on a weekend and considering how tight your schedule is back home. So thank you for joining with us today. I hope that we can have you for another technical session in future as well. I also like to thank all the participants who joined from Sri Lanka, UAE, Kuwait, Qatar, Bahrain, and all the members of other professional bodies as well. Thank you, everyone. We'll soon meet with another session. Have a good evening. Thank you.
Thank you for inviting me. Thank you. Bye-bye.